Welcome, everyone, to this legal webinar. Today's topic, tax issues, entity and deal structuring. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys James David Williams and Bill Barlow are going to host this session. James David and Bill are partners in Barlow and Williams, a practice that specializes in small business M&A. Today, they're also joined by Josh Siegel. Welcome back, Josh. Josh is leading the tax group at Albrecht Law. The way we run these is that Bill, James, David, and Josh will give their presentation, and then we'll do Q&A. To ask a question, use the Q&A function of Zoom. We have chat turned off, so look for the Q&A button. If you have a very involved question, very detailed, very in the weeds, we might not get to it, but ask it anyway, and James David will try to follow up with you after the fact with an answer. If you do that, just make sure you're not logged in anonymously, because then, of course, he cannot reach back out to you. We are recording the session, as always. We will send a link to that either later today or first thing tomorrow. We'll also have the slides that you're about to see in that email. So all of that will be in your inbox soon. And I'll put some links here in the chat to where you can connect with Bill, James, David, and Josh. And Bill, James, David, over to you guys.
All right. Well, everybody's favorite topic, taxes. Thanks you guys for joining. So just overview, we're going to be covering kind of three main points. One is the entity structure that you're going to choose when you make an acquisition. What are the different considerations? The other is the deal structure itself. You might have heard asset purchases, stock purchases, F-reorgs. We're going to sort of disentangle that and say, what are the ones that will be appropriate for your situations? What are the costs and benefits, pros and cons? And then one other thing is give you a little sense of what legal tax diligence looks like, including how that might change based on the different structures that you choose. There's a lot of slides here. There's a lot of material. So we're going to go a little quickly, but do feel free to jump in with questions and we'll do the best we can. All right. So let's start off just talking a little bit about the most common deal structure, which is an asset purchase. This is a preferred structure. It's the one that leaves you with the least legacy liabilities, both from a federal income tax perspective, but also from just legacy liabilities from lawsuits perspective. You get to depreciate the cost of the assets. So this is usually the preferred structure. If you're forced out of this structure, it's usually because of something like contracts that are difficult to assign, licenses that are difficult to assign. Sometimes, if the target company is a corporation, they're just never going to want to do an asset purchase or an asset sale because it will be a horrible tax consequence for them. So this is the preferred, but it's the preferred deal structure, but not always the deal structure that's achievable.
Yeah, and the main alternative, right, is a stock purchase or an equity purchase. Right? Stock is, if it's shares of a corporation or membership interest of an LLC, but stock and equity purchase is interchangeable. If you do this, right, it's marginally easier from an operational perspective. Like you don't have to go to the DMV and retitle a bunch of vehicles, for example, because the entity continues as it was. It's easier to do an equity roll in a stock purchase. If you are using SBA financing and want to have a seller roll, then this is the only way to do it. Right? You're forced into the structure. And depending on what the tax treatment of the seller entity is, right, the stock purchase can be much more favorable for the seller. It does come with a heightened risk for you as the buyer. You assume their tax history, you assume the seller's tax history, you assume certain other liabilities also. And if it is a corporation, you can't depreciate the value of what you're buying. It becomes your basis. Um, if you're buying the equity of an LLC, whether that's it's disregarded a single member entity or a partnership, then you are able to make certain tax elections in order to soften some of those consequences from the tax perspective, but you still inherit more liabilities.
Yeah, so I will jump in here to talk about the fun topic of tax diligence. So the scope that is recommended, that I would recommend for tax diligence, it depends on what the deal structure is. So, the starting point is what Bill and James David just went through is how is the deal going to be structured? Is it going to be a purchase of assets, a purchase of stock or equity, or is there a synthetic way, which I believe we're going to get into later into the deck? There's certain tax elections or a transaction called an F-reorg, depending on what the seller legal entity structure is, where, we can achieve the effects of an asset purchase from a economic standpoint with getting a step up in basis and getting additional depreciation and amortization. Um, and so really that's a starting point. And then what I would recommend from a tax diligence scope flows from there. So as James David said, acquiring C Corp stock or S Corp stock, when you're acquiring the stock of an entity, that's where you're going to have the largest and most comprehensive scope in tax diligence because that's where you have the largest potential exposure for successor liability. And again, even between a C Corp and an S Corp, if you're buying the stock, there's differences in the scope. With an S Corp, you really want to diligence, how good do you feel about that S election? When it was made, timely, eligible shareholders, non pro rata distributions, anything that could have blown the S election, that's very important to add into the scope. Um, but with the C Corp, S Corp, partnership interests, acquiring assets, there's still always going to be some successor liability in the area of taxes. And that's generally, even in an asset deal, you're going to have successor liability for non-income taxes. So that's your sales tax, use tax, if there's any personal or real property tax, gross receipts tax, employment related taxes as well as any unclaimed property or escheat issues. So I would say that in my experience, it's generally the non-income taxes that end up becoming a larger issue in diligence, especially for domestic company that's wholly based within the U.S. A lot of times the focus is on income tax, and everyone has their eye on the ball with income tax. But, the sales tax rules can differ state by state. Companies are growing. Management teams are focused, rightfully so, on sales and generating revenue and not having cost balloon. And they're not always as focused on sales and use tax, employment taxes, employee classification, those things. And those are the issues that can transfer even in the sale of assets. So, here's a typical process. I just thought I'd put this in the slide for how to think about it. So yeah, scoping out the engagement depending on deal structure, then depending on the scope chosen, sending out the tax diligence request list. Then it's reviewing all the data in responses populated in the data room, then having a management call to go through all the follow-up questions. And I would say that, you know, having a really good diligence provider, the art of it is in the follow-up question, right? A lot of people can read the tax return and take the documents, but it's, getting on the management call, going through the questions in detail, asking a lot of follow-up questions, really digging in, that's going to get the best in, say the most information coming out of the tax diligence process. And then, inevitably there's follow-up requests and then drafting the tax diligence report. Um, and these are the items I went through. There's diligence on federal income tax, state income tax, sales, and use. You just say sales and use tax. They're different taxes. Um, Employment tax, property, personal or real, unclaimed property sheet, and then if there's any U.S. international tax aspects involved, that's also very important to diligence. So I don't know, Bill and James David, if you want to talk about this a bit, or I'll just keep
Oh,
Yeah,
going.
I know you've been talking a long time. We'll just kind of briefly just go through. The main thing we'll just say on sales tax is that there's two things. Number one is sometimes, and this used to be a problem more like a long time ago. There's the concern that since you're buying assets, does sales tax apply? And the answer is no. In most circumstances. There can be exceptions. I think like sometimes transferring vehicles can have a sales tax in some states, but for the most part, you're going to be covered by a bulk sales law exemption because you're selling the entire company. Um, uh, uh, so that's usually the case. Um, there usually is a line about allocating responsibility for transfer taxes. We'd like that to be allocated to seller, but you know, um, hopefully in most sales with most property, that's not an issue.
Yeah, I would say be careful in Pennsylvania. Pennsylvania has some really interesting transfer rules and taxes on even internal restructurings. Each step in each internal restructuring can be subject to transfer tax in
Oh my gosh.
Pennsylvania. Yeah, just something I've had to
This is
deal
why you
with.
get the experts, folks, because they know stuff like this.
Yeah, yeah, but agree with everything Bill said. And then, from a diligence standpoint, you're really looking at did the company, where you got to look at revenue by jurisdiction and where did the revenue and when did it cross the kind of minimum thresholds for reporting in that jurisdiction. And, kind of a broad rule is $100,000 in sales, then you really need to start thinking about reporting usually both income tax and sales tax in that jurisdiction. I wouldn't say there are jurisdictions with higher thresholds and lower thresholds. And then you get into looking, are the taxes exempt? There are certain sales that are exempt from sales tax. Um, and then, sometimes it's partially exempt. So it's a long way of saying that sales tax can be quite complex, both in administering it as you're operating the company and in diligence. So if, there's any operators out there who's like, oh my God, I need to think about this, feel free to reach out. But this is a very important area to diligence.
yeah. Especially if there's, where it comes up most commonly is if there's an e-commerce component to a business. Uh, Although certain thing and the rules are constantly changing, the thresholds are constantly changing. I think California next year is putting in sales tax on software potentially, which is a whole nother thing that's going to change. So it is something that continues to evolve.
Yeah, I think the big theory on that is states always are looking for more revenue, new revenue streams. And so, it used to be common that like, oh, it's a service, it's not subject to sales tax. I would say that's not as true as it used to be, and it really depends on the jurisdiction. And as James David said, that California is looking to tax. So when your Microsoft Office subscription, now we all pay yearly subscription instead of a one-time fee every time they come out with a new version. That's now going to be subject to sales tax in California. Leave it to California to tax us even more.
Now we'll turn to a couple documents that are state specific, and every state is a little bit different in how they do these next two slides. Some states don't do them at all, but anyway, somebody else can have tax clearance letters. It's not my favorite subject.
All right, I'll try it. So, tax clearance letters. This is something that your bank is definitely going to ask for. Basically, you're just asking the state authority, "Hey, can you confirm that this business entity that we're about to buy or buy the assets of doesn't have any outstanding taxes? If they do, then you pay that off before the closing. There are some states, notoriously Connecticut, where it takes a while to get these tax clearance letters, and you often actually have to put money into escrow, and then they give like a final letter, and you pay it or you release from escrow. So this is also a good thing to keep in mind because there are different states. Some states it's like 10 days, some states it's automatic, it's right away. And so when you're trying to get to closing, the last thing you want is you think you're going to close this week, and then it turns out that your state has like a 10-day tax clearance period. And now you can't close end of the month like you wanted to. So this is a good thing to keep in mind. Another thing you should know about is that sometimes there could be multiple authorities. Like you might need to send one clearance for like the payroll taxes and one for kind of state income taxes. And again, each state is its own little special snowflake. So you just got to be careful.
Yep. And then, yeah, bulk sales law. Again, I would say the trend seems to be states, getting rid of bulk sale law, but they're still on the books in a lot of states. And basically, what the bulk sale law is to protect is that, if a seller sells all the assets of a business, and they owe vendors money, and there's certain liens out there, they're trying to like circumvent, um, paying off certain liabilities that are, the ability to pay is driven by the revenue generated by the assets. This is basically a notice, so that vendors get paid and nothing is done in kind of a to circumvent, paying off liabilities related to the assets.
Yeah.
And like the tax clearance letters, it varies by state as far as what you have to do, and timing varies also, and this can take weeks. So,
And to that point, I know these just sound kind of procedural, and that's because that's what they are, but they're also, they can really affect the deal. We've seen situations where, well, luckily, we don't really see situations because we take care of it earlier, but like there can be situations where if you don't take care of this in time, it can be the straw that breaks the camel's back, right? Like the seller is often dealing with seller exhaustion. They've been going through this process for months. You're finally looking to close. And if it's like, oh, you forgot to do this thing, oh, we have to delay closing by another month because we want to close at month end, that sometimes, in a worst case scenario, it could cost you the deal or make the seller try and retrade stuff. And so even though this is just process in some sense, that doesn't mean it's not important. All right.
So yeah, now we're getting more, we're getting back into structure considerations. And so an F reorganization is a really great tool, generally when the selling entity is an S corporation. And so for all the reasons we discussed earlier, step up in basis, successor liability, a buyer generally does not prefer to buy S corp stock. And also there's a question of shareholder eligibility. So again, it's generally individuals or certain types of trusts are the only types of shareholders that can own an S corp. And so if the buying entity is an LLC taxed as a partnership, um, which is very common, on the buy side, it's actually not eligible to buy S Corp stock, and if they do, it would revert to a C Corp. So not ideal, especially if you're intending for the structure to be flow through. So a common structure is an F reorg, and essentially, at a high, just to quickly mention what it is a seller forms a brand new S Corp. This is an F reorg is all on the sell side. It's a pre-transaction, set of steps the seller will take, usually in coordination and fully spelled out in the purchase agreement. So seller forms new S Corp, contributes a legacy S Corp down below, make what's called a Q sub election for the legacy S Corp, and then at least one day subsequent to the effective Q sub election, they convert that entity, generally via state law filing some forms, to an LLC. So at the end structure, you have brand new S Corp with a new EIN holding a disregarded LLC, and that LLC has the legacy EIN. And so this is a very elegant solution when you have some of the problems that James David mentioned early on, difficult contracts to transfer, difficult licenses to transfer. A lot of times, F-reorg can be that solution.
Yeah.
And then a 338H10, and I believe the next slide is going to be a 336E election. These are two elections when a target is, well, I'll take a step back. A 338H10 election can apply when the selling entity is either an S corp or it's a C corp that is being bought out of a consolidated group. It doesn't work for a standalone C corp. Generally, in the, say the lower middle market, it's typically going to apply when the selling entity is an S corp. And what this does is allow you to buy S corp stock. So I've seen one deal where it was in the state of Ohio, a particular license, the state regulatory body, wasn't convinced that even in an F-reorg, they thought that the buyer would not retain the same grandfathered rights of having this legacy license. So we shifted and we actually, we did a 336E, the next slide, but we did one of these elections, which you buy the equity of the entity. So then there's no problem with transfer of any assets that's held by the entity. And when you make this election, it's treated as buying assets from a tax perspective. So you still get a step up in basis. And you still get the increased amortization and depreciation. Yeah, and then you see the requirements for it. There are some technical requirements. You have to purchase at least 80% of the stock within 12-month period. And again, here the seller has to be an S corp or a corporate subsidiary out of a consolidated group.
And just a little practice note here, especially in the lower part of the market where you sometimes have unsophisticated brokers, you will occasionally see situations where a target company comes to market as a C corporation, and you realize that's an issue, and the broker will wave away and say, it's okay, you can depreciate the assets, just make a 338H10 election. Assuming that you're not selling out of a consolidated corporate group, which you're very rarely doing, if it's a true C corporation, that's not available. So don't assume that if the target is a C corporation and the broker is saying, don't worry, 338H10 election, do not assume that that will actually be available to you, because most of the time it's not.
Yeah, no, in our practice, I think we've had one transaction in the last 2 or 3 years that was eligible for a 338H10. And even then, they chose not to do it for other reasons.
Yeah. And I've only had one that did, mainly because of license transfer reasons. And otherwise, it would have been an F-reorg.
Yeah.
And so a 336E, there's some definitional differences between the two, but really it's for all, intents and purposes, it's the same requirements. The big difference between a 336E and a 338H10 is who the buyer can be. Again, the target has to be an S corp or a C corp out of a consolidated group. At 338H10, the buyer has to also be a corporation. A 336E was put into the code in 2013 to allow the same benefits to a broader array of buyers. So here, the buyer can be an LLC, taxed as a partnership, an individual. It's much more flexible, and much more applicable to the structure that the buyer is typically in, at least as far as I see.
But again, right, when people are buying S corps, it's much more common that the F reorganization is used as opposed to one of these elections. And there are other reasons for that around shedding certain liabilities too. There's additional benefits to the F reorg.
Yep, agreed.
Okay, so now we'll pivot to holding company structure. which is, in other words, the entity that you form as the buyer to facilitate your acquisition.
All right. So the most common one is the LLC. I'd say the great majority of the ones that we see are just a simple limited liability company, taxed as a partnership if there's more than one owner, or a disregarded entity if it's just one owner. Um, Most of the companies that you see being bought are very cash flow positive, and this is a great way to be able to have those cash flows pass on to you as the owner without paying double taxation and certain other things. Uh, One thing to keep in mind is we'll talk about this benefit later on, but you're not eligible for something called QSBS. If you do that, you can restructure it, but that would start the clock over. That's not something that you're eligible for. And the other thing to keep in mind is that if you're going to be reinvesting a lot of money into the business, sometimes a C corporation structure might be preferable because the money is then taxed less. But I will just say, in general, if you don't know, LLC should be your default. But certainly you can talk to your accountant and your other tax professionals to see if one of these other options actually makes sense in your particular case.
Come on, Bill. They got to talk to their tax lawyer, not their
Oh, that's right.
accountant.
That's right. I'm sorry. I'm sorry. Talk to
Uh,
Josh specifically.
Yes, thank you. No, but just going back to the LLC. So one thing I wanted to point out is just the general tax regime, around an LLC that's taxed as a partnership, which so an LLC with one owner is by default disregarded. So it would basically just be reported on your Schedule C. You could still take business deductions and all of that. When there's two or more members of an LLC, the default treatment is a partnership. So you've heard us say an LLC tax is a partnership. So when there's two or more members, the default is you would file a 1065. So everything would be on a separate business return, no longer on your Schedule C on your personal return. And just something to point out, as we keep saying the word flow through, flow through. So you're taxed on the income of the LLC, not necessarily the cash you receive as a partner. So that's something to take into consideration, as Bill pointed out, to Bill's point, if you're constantly reinvesting in the business, say you're making money and then you're reinvesting in the business. Now, you could buy assets that are going to give you more depreciation, but doesn't always get depreciated in the first year, 100%. There's time value of money. So you can get to a situation where you have just called $1 million of income. And at the end of the year, you've like, well, I've only got 300,000 of cash. And now all of a sudden you have a much bigger tax bill. So that is a situation that can arise. And then there's ways and important things and it's beyond the scope of this call, but there's a lot of tax considerations in an operating agreement for an LLC that are very important to consider so that you don't get stuck in a situation with a lot of, we call it phantom income, where you're allocated income, but you didn't get the cash. And, there's ways to make sure you get enough cash at least to pay your tax bill that are pretty common in operating agreements.
One other thing I'll also say, just on the operating agreement points, is that one nice thing about the LLC is that it's a pretty flexible governance structure. We're going to talk about C corporations and other things, but if you want to make your lawyer's life easier, usually operating agreements are pretty flexible. If you want to create things like preferred shares and you like with corporations, there are more specific things that you have to do in a corporation. And so just keep in mind that LLCs, there's a little bit more flexibility there just from an ongoing management perspective. Compared to corporations, there's more of like a list of things that you have to do. And, sometimes you have to make state filings if you want to change around like classes of shares and that type of stuff. So just keep in mind in terms of ease, LLCs might be a little easier.
And yeah, one other quick point that, we're pinging off each other here, and as Bill said that, it brought something else to mind that I think is important to mention. With an LLC, you can issue what's called profits interests. which is a really nice tool for employee equity grants, where, the employee is a very key employee, and you want them to really partner in the business and to have a stake in the growth and to be all in, or they've done such a great job in doing that, and you want to reward them with some equity. With an LLC, you have the flexibility to issue profits interest, where from the time the grant is made, you look at the fair market value of the company on that date, and the employee, whoever receives the profits interest, gets the upside from that point going forward. And so it's a tool that you can give upside, equity upside, and not cause a current taxable event for the employee. As opposed to a capital interest, if you just gave someone a regular old 5% of an LLC and the fair market value, is $1 million, you'd be giving them 5% of $1 million, and they'd be taxed on that value. So again, profits interest is really only available with a partnership, so an LLC taxes a partnership, or literally a limited liability partnership or some other legal entity. But it's something to consider.
Okay. The other main entity structure is a corporation, and we have a separate slide for S corps. So this corporation, right, it can't be taxed as a partnership. It could be an S corp, maybe if it's eligible. That's on the next slide. But usually, when we talk about a corporation for federal income taxes, that means a C corp. And so, what that means is, right, net income is taxed inside the corporation, and then you would pay taxes again on a distribution, right? That's the double taxation that comes with a corporation, which often nets to be a slightly higher tax rate than the disregarded structures.
Yeah, when thinking about a structure broadly, and a lot of people start out the conversation, what's the best structure? And there truthfully is no the best. It's what are your business goals, and how can we design a tax efficient structure to help you meet those goals? So if you say, hey, this business is a cash cow, it's going to throw off a ton of cash every year. And oh, by the way, my investors are expecting some pretty nice distributions along the way. I promised them that. C Corp's probably not going to be a structure that makes sense. Even if there's other benefits that seem great in the C Corp structure, that double tax that James David was talking about, that comes about. So you think of a corporation as a box. Everything stays inside the box unless the board of directors declares a dividend and says the money is going to come out of the box. So all the money, all the profits, taxable income inside the box is taxed at 21%, which, you guys are all probably pretty familiar with the individual tax rates. 21 is pretty low. But if you declare a dividend and you pay out that cash to the shareholders, that's going to be taxed at, generally at long-term capital gains rate. So at least another 21%. And there might be certain states where there's some deductions, but let's just say there's a 4 to 5% inefficiency if you're going to pay out all of your cash in distributions. Now, if you said you're only going to pay out 20% or 10%, that delta becomes a much smaller portion of the overall profits. So it could make sense, but it's something, we can generally model out to, really help determine what is the tax efficient structure that's going to meet your needs.
Yep, and that's during the operating period, right? During the whole period, if we want to talk about that, right? The C Corp does have the benefit of QSBS, qualified small business stock.
Yeah.
Asterisk, it must be, right? There are very rigid requirements for
Yeah.
QSBS eligibility because it is one of the very few exclusions in the tax code. But QSBS was made more interesting, at least in some circumstances, based on some changes in tax law that went into effect last year.
Yeah, really, the both iterations of the Trump tax cuts in 2017, which reduced the corporate rate to 21%, that's when QSBS sort of had this renaissance because QSBS, and I'll go into what the benefit of that is in a minute because that's really the headline here. With a corporate tax rate at 35%, it was still speculative whether you're going to have the exit. You know, it really wasn't worth the risk, and most people weren't C corps unless you absolutely had to be. Just that 35% corporate tax rate wasn't worth it. Then the tax rate got lowered to 21. It's like, okay, this is starting to look a lot better economically. So the headline benefit of QSBS, and again, you can only get it if you are a C corp. And I'll go into some other headline requirements in a minute, but the benefit is you can completely exclude, so pay 0% tax. And again, we're talking about federal tax, and this does apply to most states. Unfortunately, I live in California and California does not conform, so I would still have to pay full California tax. Most states do conform, so you'd have zero at federal and state. But at least for federal purposes, you'd pay 0% tax on the greater of $15 million or 10 times, basically 10 times your investment. So if you invested 2 million in your own deal, you could potentially pay 0% tax on up to 20 million in an exit. So, and that's on a shareholder by shareholder basis. So it's not 15 total, that's 15 per generally individual investor. And you can hold QSBS through flow-through entities. So if you're like, oh, they set up an operating partnership, an LLC that owns a C Corp, can that still work? Yes, you can, as an individual owning an LLC that owns a C Corp, you can still get the benefit. Some of the requirements, and as James David said, it's quite technical. And I was just thinking, well, at one point we should do a whole hour show on QSBS because it really, can handle it. Um, there's a holding period requirement, and this is the change that James David was just referring to. That's a benefit. It used to be 5 years, all or nothing. I'll caveat that there are some rollover provisions where, if it's just to continue your holding period, that even if you do a transaction, you can still get the benefit if it happens before the 5 years. But essentially, it was 5 years, all or nothing. Now the recent changes, now there's a 3-year, a 4-year, and a 5-year holding period. You get 50% of the benefit at 3 years, 75% at 4 years, and 100% at 5 years. So it does, if a deal comes up that's too good to be true and it's an all cash deal and you're not going to roll anything over, at 3 years, you can still get a half the benefit. And it's not like you have to push it off and hope that the circumstances remain the same in 2 more years. So it offers a lot more flexibility. And prior to the change this past year, the stock had to be issued before the company got to $50 million value in assets on the balance sheet. Now that went up to 75 million. So the definition of a small business and when small business stock can be issued got more flexible. And when you can achieve the benefits got more flexible. But the headline benefit is quite nice.
And it's not, as perfect as certain internet gurus will say, right? There is the higher tax rate during the operating period. There can also be potentially a discount on exit based on what we talked about earlier, right? You as the buyer want an asset purchase. Well, if you own a corporation, you definitely don't, right? And so there are some trade-offs that you can model out. It's not as simple as some people maybe want it to be, but it can make sense for certain types of business strategies.
Yeah.
And one other thing I'll just mention on QSBS is not all businesses are eligible. So, professional services businesses particularly are ones that generally are ineligible, and there can be other things that are ineligible. So if you're banking on QSBS, it's worth talking to Josh to make sure that that you're going to be able to get the hoped for outcome when you go to sell the business.
Yeah, I do a lot of work on around QSBS and eligibility, both when setting up structures on at the forefront, and also upon exit and in writing technical memos to give shareholders the most defensible position and feel comfortable with taking that position on their tax return. Oftentimes tax preparers are not very familiar with QSBS. They see it maybe once in a while or it's their first time. And it's something that I deal with quite often.
We'll talk briefly about the S election. So if And you can start as an LLC, tax as a partnership, and move to an S corp potentially also, right? So once you're a C corp, it's sort of a one-way ratchet, right? Once you're a C corp, you're kind of stuck as a C corp, but you can go from LLC as partnership to S corp, maybe. Um, there can be certain tax benefits to making the S election around self-employment taxes and the like, but there are some restrictions. There can only be individuals or certain trusts or disregarded entities. You can't have preferred equity. There's only one class that's available in an S corp. You can't have, differential distributions, right? You can't have preferential distributions. Uh, there's also limits on the number of shareholders, but that's a much less common issue. And if you do blow the S election, and this is why Josh talked about it from a diligence perspective earlier when the target is an S corp. But if you blow the S election, which means you do something that makes it ineligible to be an S corp, whether that was filing the wrong paperwork or which that can often be remedied. But if there have been like true common preferred equity and distributions made only to the preferred for a number of years, well, okay, that's not actually an S corp, and then retroactively it's a C corp, and then you're dealing with a real mess. So,
Yeah.
but
Yeah.
it can make sense to be an S corp. It often turns into a conversation with your accountant as to when that crossover point maybe exists.
Yeah, and a C corp can make an S election. Um, but if you are taxed as a C corp and make an S election, any built-in gain, so just say you started the C corp from scratch and just say your company's worth 2 million bucks, and when you make the S election, for 5 subsequent years, if you try to do an F-reorg or one of the elections we talked about, and you try to structure it as an asset sale, you're going to have the corporate level gain, corporate level tax, 21% on that built-in gain on the value of that $2 million. Now, the value could continue to grow to 10 million, but that 2 million is going to be subject to double tax. So, again, that's another reason why if you start off as a C corporation, you want to be pretty certain that like, hey, for at least the 5-year period, we're going for QSBS. This is in everyone's best interest, and we're really intentional about this choice. Otherwise, starting as an LLC, you have a lot more flexibility, and it doesn't trap you into this sort of idea of built-in gain, even going from a C to an S. And I have a deal right now. This just surfaced literally on Friday, where it's an S corp. And my client's the buyer, and he starts talking about, well, they want QSBS. I'm like, that's interesting. It's most certainly not eligible, but I'm like happy to hear them out. And what it was is the sell side attorneys didn't, I think the seller always said C Corp, C Corp, but they made an S election about 3.5 years ago. So they're stuck in this like, there was built-in gain and it's going to result in, up to about $1 million of additional tax in the deal. So it's a very real issue. And now we're stuck like with a buy, the LOI says asset deal, but now it's going to cost the seller an extra million. Like, how do we bridge this gap? And there are economic ways to try to bridge the gap, but it's an unfortunate situation. It's just like an odd fact pattern, but it's an example to show how important structuring is and how far structuring can go, structuring at the forefront can go to avoid messy tax situations.
Yeah.
Okay, so now we'll talk quickly because we're going on time. We do want to leave time for some questions, but treatment of deferred payment. So this is in your transaction itself. Uh, so promissory notes, right? A common structure, a seller note. Um, there are, right, consequences on interest, um, as far as it is, it is deductible for the buyer, it's income for the seller. Maybe one of the more common things is that we see, it doesn't happen often, but sometimes people come to us with a 0% seller note. Um, just know that that does result in imputed interest income anyway for the seller. Um, So often, if somebody comes to us with a 0% note, we will end up changing it to the IRS AFR as a table based on the life of the loan, etc. We'll often change it to make it easier for the seller and then extract value elsewhere in the deal. Um, Cancellation of debt, another sort of item. It This is not usually an issue for promissory notes. So, commonly in SBA deals, there will be a forgivable seller note. That's a term a lot of you have heard. So there's actually an exclusion or exception for that. So that forgiveness is not taxable income for you as the buyer. But other sorts of debt, right? Debt forgiveness, the IRS in general treats as income. And so just something to be aware of. Um, Somebody else take
Yeah.
earnouts.
And then earnout payments, sometimes sellers get questions about this. What's my tax treatment going to be if I get, paid contingent on EBITDA or revenue hitting certain things? And the answer is that it's the same tax treatment in general. Unless, sometimes if you don't structure it right, you can, and you put it into a consulting agreement or employment agreement, then it's ordinary income, and that can be a little bit different. But most of the time, it's, if properly structured, it's kind of an installment payment as part of the sale.
Yep.
And then we'll just briefly go through here. Just know that if you're paying consulting agreements, employment agreements, if you're doing options and warrants, those can have their own, tax treatment. So that could be a whole whole presentation in and of itself as employment taxation and how that factors in. Just know that the seller, as you're making decisions about whether to pay the seller in an earnout versus pay them pursuant to a consulting agreement, know that there are different tax implications for both. And, like in general, if the seller is paid in a consulting agreement, that's generally going to be speaking, favorable for you because you get to deduct that immediately, not favorable for the seller because that's ordinary income, as opposed to in an earnout, they could get usually more preferential tax treatment in compared to what they'd get in a consulting agreement. And feel free to chime in, Josh. I'm sure I oversimplified that, but that's kind of the general idea.
Yeah, no, I think that covers it. And I know we want to get to questions, so I wasn't going to try and jump in and have more long-winded tax talk here.
All right.
No,
Well,
so that is the last slide. So we'll get to questions in a bit. So as we'll start to see that. So if you do have questions, you can go ahead and put them in the chat or the Q&A function now. And before we hand it back over to Will to MC that, Bill and I, right, we're partners at Barlow and Williams. We are an M&A firm in the lower market. We work with buyers and sellers. We do all of our transactions on a flat fee basis using milestone-based payments. And Josh, again, is the partner at Albrecht Law and oversees their tax department. So that's us. And now I'll turn it back over to Will for questions.
Great. Thanks, James David. Great presentation, guys. This is important stuff. Confusing. It's always a good refresher for me, even though I've seen it a couple times now. A lot of questions were coming in as you talked, so let's dive right into those. Mike asks, on the forgivable note, two things. One, does 0% get imputed? Is it a gain? And two, is it a gain to the seller if forgiven?
So where is it's this slide. Okay. So the interest, if it's a 0% seller note, the seller will have to pay imputed interest anyway on the seller will be taxed as if they had received whatever the interest is in the AFR chart, which right now is like 3 or 4%, depending on how long things are, right? It's very this number of months. They're, there's the different categories. So the seller will have to pay income tax as if they received income, even if they didn't, which is sort of a gotcha and why we'll usually trade that away for some other benefit in the deal. What was the second part? It was something about
Uh, is it a gain to seller if forgiven, which I think is what you just said?
so that the 0% interest there will be imputed tax that they'll have to pay.
No, I think
If the
they're
seller,
asking if they forgive the note, is that picking up, income?
yeah, no, not
Mm.
for the seller.
And it would be like in any case, forgiveness of the debt would have been income for buyer because the buyer's debt is the thing that's being forgiven. But again, there's exceptions that apply
Right,
for these instances.
right, right.
Yeah.
Okay. Okay. Um, I'm currently dealing with an asset heavy C Corp as a stock sale. Is QSBS still available to use?
Yeah. So, you know, I so if this is from a seller perspective, I would say, it is just so dependent on a lot of facts. And like I said, we could do a whole hour presentation on QSBS. If you're selling C Corp stock, you've held it, presumably at least 5 years, because that 3 year the tranched holding period I talked about only starts for shares issued after the date that that rule went into effect, and it hasn't been 3 years yet. So presumably you've held it for 5 years. It's an eligible business. I mean, there's so many assumptions I would have to make to say yes or no. I don't know, but happy to have that conversation in detail. And, I think quickly we could figure out whether there's a directional chance or not.
And if you are forced to buy the shares of a C Corp, it might also be possible that you could make a QSBS play yourself by setting up another C Corp on top of it in order
Yeah.
to make the acquisition. So again, there could be a way, probably should be a way, assuming it's an eligible business and all the other things that would need to be analyzed. But it's at least worth having a conversation.
So wait, so another question here. Thoughts on forming an LLC S Corp to acquire target C Corp stock, then making a uh, QSBS election for the target?
Sure. So yeah, you can own QSBS stock, so C Corp stock that's eligible for QSBS, you can own that through a flow-through entity. So either an S Corp or an LLC. Generally, if you have, especially with other investors that are coming in through their own vehicles, like an LLC generally is more common than owning QSBS through an S Corp, although you can do it. Um, and there is no QSBS election. It's actually just a position you take on your personal return. There's nothing to proactively do other than the analysis to know whether or not it can qualify, and that's something you're shooting for and expect. But, it's something you only do upon sale, and it's at each shareholder's individual tax return where you take the position that your gain was, eligible to be, for pay zero tax on your gain because of QSBS.
Chuck asks a good to the heart of the matter issue on QSBS. Do you see a lot of QSBS deals happening? And when you do, is the savings generally a wash because of the added risk a buyer is taking that it might lead to a lower purchase price or other risk mitigation reductions? How often do you see it being worth it? How often do you see it and then see it being worth it, Josh, or
Yeah.
everybody?
So I would say that it's becoming more and more common. Again, the idea is set up an LLC that then wholly owns a C Corp, and that C Corp is the buyer, and so that's what you're using, the structure you're using to try and get QSBS. That's becoming more and more common. A lot of my clients are setting up with the intention to get QSBS, assuming it's an eligible business. And I inform them of all the other requirements, and they feel confident of meeting that over this successive 5 year period. Um, I always, because like there's definitely, you go to PE roundtables and talks, and they talk about, we'll
Yeah.
pay less for C Corp stock. But, is there a neutral position? And then it's like they pay more for an asset deal and less for a stock deal. Like it's hard to anchor on, clearly they might pay you a premium for an asset deal, but are they really paying you substantially less than your business is worth for a stock deal? That doesn't seem to be what I see. I think there is less consideration paid, but I think that when I've gone through this with my clients, the benefit of getting QSBS is something they're highly interested in and choose to be in this structure.
Yeah.
I
And
think a lot of it goes to also, are you going to distribute a lot of cash year over year? So if you're, hey, I'm going to invest in this business and grow this business, so now you're being taxed at 21% as opposed to the highest personal rate, 37 on a yearly go forward basis and potential zero tax on the exit. I think the math does work out.
yeah, and it's more common when people are pursuing a roll up or some sort of consolidation strategy than like this is the one I'm buying and that's it. Um, I will say if you're using ROBs, then you have to do that through a corporation, so you might as well try to make a QSBS play if you're using that financing option. Um, but it's becoming more common, right? Because 0% is an enticing thing.
Yeah. It's one of the few exclusions. It's not a deferral. It's not like paid in 10 years. It's just you don't owe it ever.
You mentioned the PE roundtables, Josh. I was gonna chime in with a similar observation that a little bit upmarket in independent sponsor land, this is a very popular approach and hot topic. So I would say it's definitely not some obscure thing. It's something that serious business buyers are look very closely at, and whenever possible.
Yep. I'm glad you're seeing that too, Will.
Um, and yes, I do think that there's another webinar just in QSBS. Another QSBS question. I have a situation where a longtime owner taxed as a partnership is considering retiring. Can the LLC be converted to a standard C corp and held for 5 years and get the QSBS treatment?
Yeah, so there's definitely ways I would, so it's more technical than that. I would not, with an LLC, it's an eligible entity for what's called a check the box election. So you could literally check a box on a form and make it a C corp as far as the IRS is concerned. I think there's a technical issue with that is did that entity ever issue C corp stock, right? Like because you're just filing a box, it's not a corporation under state law. You're not issuing stock. So I think there's potential technical issues. So there is ways, with forming a new C corp, contributing it in, and going through the what I would say is like the best procedure to get there. But I do think it's possible.
We've done it for a few in the last year. So it can be done, but you know, you'd still need to go through the structural analysis of how to do it, which could depend on what state you're in, and you still need to make sure all the other requirements are met, some of which we've not talked to about because they're pretty technical.
Yeah, and you usually start the clock once that reorganization is done. So, like you said in the hypo, like you got to make sure you're not going to be exiting imminently.
Yeah.
We got three more quick ones moving to earlier parts of the presentation, so away from QSBS. But just before that, because we're right at the hour already, audience there again is contact information for Bill, James, David, and Josh. Reach out to them directly with questions. Connect with them on LinkedIn. And Bill and James David will be back next month. We'll be promoting that closer to the event. Final three. Is an F-reorg permissible under SBA in a situation of partial change of control?
No, that was one of the things that is the multi-step partial change of ownership that was taken away uh, last year.
Right. Does my attorney do the tax diligence or does the accountant I hire for due diligence do the tax diligence?
So
Yes.
often your QoE provider, some QoE people do, but a lot of QoE providers do not offer this, or if they
Yeah,
do,
it's really a
they're
distinct offering. I think for quality of earnings, if they have a partner in that accounting firm or whoever's doing the quality of earnings that is also like an M&A tax professional and does tax diligence, and they can certainly handle it. I see oftentimes where like a QV provider is like, oh yeah, we can get someone to do tax diligence for like 5 grand, or they throw out like a really low number, right? And then I would always say like, well, what is the scope? Like sometimes that 5 grand is like, oh wait, I would recommend don't pay anything because it's like not worth the money you're paying, even though that seems like a lower number. If I can do tax diligence for 5 grand as opposed to 15 grand, but the 5 grand, I might recommend don't even spend the five because you're not really getting anything versus the 15 is like, a full scope that's going to be there to protect you and uncover, potential liabilities. So it just depends. But yeah, some firms are set up to do both very well. And then I guess like I work for PwC and Deloitte and the M&A tax group. So I've done, probably well over 200 diligences. My largest deal was 40 billion. I've done a lot of double and single digit billions, and then a lot in the hundreds of millions, and then a ton in the, call it, 2 to $50 million range, and kind of the deal market that I work in now. So it's just finding the right experience. And sometimes accounting firms are fantastic. And then sometimes it's, I have experience in accounting firms and law firms. And so it just, I would say it depends more on the professional.
Yeah.
Last one. How far through the DD process is the ideal time to engage a tax diligence consultant?
I would say, like, honestly, engaging with a tax professional that, is going to assist with structuring, diligence, kind of a lot of the topics we talked about, even pre-LOI makes sense because I think there's certain ways and things to communicate in an LOI that set you up to make it very clear of what the expectations are, and that no one could ever, seller could ever accuse you of trying to retrade because you thought it meant this and they thought it meant that, right? And then for specifically kicking off diligence, it's usually, once the LOI is signed, you're going to start QOV. I think QOV and tax diligence really work well in parallel. Some people want an initial read to make sure they're not going to need to retrade or the deal is going to move forward. And of course, that's like an individual preference and is fine. But tax diligence is usually, kind of in that 3 to 4 week timeline, similar to QOV, and it's mainly because, we're waiting for data. Like a seller is going to get bombarded by legal requests, QOV requests. Sometimes tax isn't always at the top of the list. So, we need a reasonable timeline to get it done as well.
Great. Thanks, Josh. Okay, everybody. Thank you for coming. Thank you for your attention. Watch your inboxes. You'll get the recording. If you missed some of the details today, you can rewatch, and the slides too. You can go through those. Those will be along with the email. Watch that for that later today or tomorrow. Bill, James, David, and Josh, thank you guys for a great, dense presentation. Your expertise, and Bill, James, David, we'll see you next month. Josh, good to have you back.
Yeah,
See
thank
you
you.
around, and everyone, thanks for coming. And this ends the webinar. Bye.
Bye.